checks 7.2 million. Total debit in banks not in-house 411 million. Total credits in bank not in-house 449 million. We noted with concerns total uncredited checks of 22 million that seems to have been deposited in the bank but not reflected in the bank statement. We were also informed by management that the 449 million noted as credits in banks and not in-house related to deposits made by unidentified customers. The next point is on evidence of review of bank reconciliations missing. We also noted instances where there were no evidence of review of the bank reconciliation statements by senior personnel within the finance department. Implications. In the absence of monthly bank reconciliation statements, the chances of timely detections of frauds and irregularities and taking timely corrective measures in minimizing exposing cash and banks to fraud and irregularities. There is increased risk that fraud could be perpetrated through dormant accounts by either NAWEC or bank staff. Bank charges will also be incurred on the accounts as long as they are maintained. Significant unreconciled difference, notably handling deposits, taking long to clear creates room for fraudulent activities. Any delay in identifying receipts paid to customers in the bank and updating records on time increases the risk of errors and unreconciled differences. Cash and bank balances and receivable balances stated in the financial statement could be misstated. Lack of independent review of bank reconciliation by senior personnel within the finance department represent the weaknesses in monitoring within the finance department. Recommendation: monthly bank reconciliation should be prepared and reviewed by senior personnel within the finance department and approved by the finance director by the 15th of every month. Management should consider reducing the bank accounts maintained to a manageable level, starting with the dormant bank accounts. The unreconciled differences, particularly deposits made to the bank and not seen on the bank statements, must be investigated and corrected as soon as possible.
Management.
Bank reconciliations are prepared on a monthly basis, but due to backlogs of posting and review, non-closure of periods, in brackets, system allow 2-year period. Some of the postings are done later. However, most of the transactions are usually posted and reviewed daily. Some of the dormant accounts listed above were not reconciled because they were dormant for years. However, we have closed 20 bank accounts, including the dormant ones. Finance is working hard to reduce the backlog of bank reconciliations by adding more support staff to the team and using Excel program to speed up the reconciliation because the system cannot do auto reconciliation. For the project accounts, example, ECOWAS and Kawur solar projects, accounts are closed only after the final closure of the project and they are maintained at the central bank. We wrote several letters to the bank in respect of the above to no avail. Nonetheless, the unpresented is to be cancelled in the subsequent periods. We are doing everything possible to resolve the issue with the banks. We'll also close accounts with banks that are not complying or responding to our letters. For the uncredited and credits in bank not in the cash book, we are of the view that some of them are mispostings on our side using wrong codes. Evidence of some bank reconciliation missing. Bank reconciliations are verified and signed off by financial accountant approved by finance director, with the exception of a few due to the number of bank accounts and the time they were submitted. We will endeavor to improve on this.
Procurement policy. Observation. As part of the company's procurement guidelines, the purchases of items costing more than $10,000 require the purchasing officer to obtain 3 pro forma invoices before any purchases are made by the company. We selected sample of purchases made during the year under review to test compliance with the company's procurement guidelines. We noted instances where 1 pro forma invoices was obtained. No documentation relating to the reason for single sourcing was filed. Exceptions noted are detailed in the table below. Implication. The company may not be compliant with its own procurement policy and could expose the company to possible risk of fraud. Purchases may not be efficient or competitive and add value for money may not be obtained. Recommendation: management should ensure that procurement guidelines are followed and proper records maintained by the procurement department. In instances where single sourcing is used, this should be properly justified, documented, and approved by the relevant authority and filed.
Members, you can see that the table is not being read. So is that all right? Is that okay? Is that okay? Well, that's why I'm asking you. The tables are not being read. Do we take it as given or should it? What do you suggest? Speed. Do we take it as given or should it be read? Leslie, what do you think? You want some detail? Yes. So why are you not reading, summing up what is in the table? Do you have reasons for not doing so?
No, I was just trying to save time. What if they want me to read it, I can just read it. It's not a problem.
Well, it's like recommendation is being given without substantively knowing what is in the table. Okay. Is there a way of summarizing what is in the table, and then go on with your recommendation?
It's in the observation already, so the details are in the table. It's being summarized in the observation, but nonetheless, she can read the table.
No, again, we are just trying to see that the content is actually submitted before the recommendation. So you are actually saying, did you get the content from the summation? So help us so that we know that what is in the table is fully understood so that the recommendation would be on spot. Okay. So, yeah.
Based on the samples that we selected, details of exceptions are noted. The fourth one is related to the purchase of a motor vehicle from Kano Enterprise, costing $700,000, and one pro forma invoice was obtained. The second one was on the 10th of February 2015, procurement of a lubricant from Aqua Energy of 1.9 million. One pro forma invoice was also obtained. On the 3rd of September 2015, hiring of genset for Bansang from Timber and Furniture. The amount is $784,300. One pro forma invoice was obtained. On the 16th of September 2015, air tickets were purchased for Alan Maru and his family to Gambia from GIA. The amount was $112,000. One pro forma invoice was also obtained. On the 29th of September 2015, they purchased heavy fuel from JNPC of $10,000. One pro forma invoice was $10 million. One pro forma invoice was also obtained.
Okay. So we can go ahead, management's response.
Thank you. The requirement for 3 quotations of $10,000, this has been amended long time and was provided to the auditors. The limit for 3 quotations is the purchase of goods and services above $30,000. For the listed purchases, all of them were purchased with justification of single sourcing, such as emergency purposes like the generator for Bansang. As for heavy fuel purchase, fuel was liberalized and NAWEC had a contract with GNPC.
I've just been reminded that it's good to read exactly what is there because this is what is being recorded. Thank you. Okay, go ahead with the next one.
Inventory reconciliation, observation. During our test of controls over inventory, we noted that periodic inventory counts were not being conducted by the stores department as per company's policy. Only one stock count was done at the year end. Additionally, we noted that reconciliations were not carried out between the stock valuation report and the general ledger as we noted a difference of 10 million between the listing of 321 million and the general ledger 311 million. Implications. The absence of periodic inventory counts increases the risk of discrepancies between the physical record and the general ledger, which may not be detected on time by management to take corrective measures. This may lead to potential misstatements of inventory balance recorded in the financial statement. Where periodic reconciliation between the inventory records and the general ledger are not done, the completeness and accuracy of the inventory records could be affected. Recommendation: as per company's policy, periodic stock count should be conducted, especially for high-value items. Management should ensure that regular reconciliations are carried out and all balances are updated according to the count sheets immediately after the exercise.
Management.
The difference of 10 million mentioned is due to the fact that the closing stock of Birkama 1, formerly known as Birkama GEG, was not posted into the general ledger at the time of the audit exercise.
Next point, reconciliation between general ledger and the billing system, which is a high risk. Observation. During our audit of the receivable balance, we noted that regular reconciliation was not performed between the general ledger and the billing system. As a result, a significant difference of 54 million was noted between the listing from the billing department of 1.09 billion and the general ledger of 1.036 billion. We were informed by management that the difference represents credits in the bank statement posted by the finance department and not posted by billing. However, the list of the credit transactions provided to us did not indicate the affected customers and the banks to enable us to verify management's claims. Implication: absence of regular reconciliation between the billing and accounting system could lead to potential financial losses and risk of fraud and errors. With such significant differences between the financial records and the records maintained in the billing system, the reliability of receivable balances is questioned. Due to materiality of the difference, the audit opinion is impacted in respect of limitations on the 54 million differences noted in trade receivables. Recommendation: a process should be established to ensure that reconciliations between the billing and accounting system are performed on a monthly basis, and discrepancies noted should be investigated and corrected on time. Management should consider integrating of the billing system with the general ledger.
Management.
Reconciliation was done on a regular basis. However, there are instances where finance posted the credits in banks, not in the cash book, and commercial could not post because bank statements do not contain the customer details required by the billing to update the customer's account, i.e. payee name, route number, etc. Several letters were written to various banks to no avail.
Absence of age analysis report, medium risk. The management of debtors and credit controls in any institution is crucial to its success. The ability to collect receivable on a timely basis improves cash flows and allows the company to cover its operational costs and reinvest in new activities. Observation: we observe that the billing system does not provide an age analysis report detailing how long debtors are taking to settle their bills so that management will have informed decision on credit control and debt recovery. Implication: the identification of long outstanding receivable balance that are virtually uncollected become difficult, resulting in adequate provisioning for bad and doubtful debt and potential misstatement of the receivable balances. Recommendation: age analysis of receivables should be generated from the billing system on a regular basis, either quarterly or monthly, to facilitate monthly performance of customers and enforce credit control policies. This should also facilitate computation of bad and doubtful debt provision policy.
Management.
The billing system could not provide an age analysis report for us. However, IT department is working with the developer, and hopefully it will be available in subsequent periods, 2016 and 2017.
Ex-staff loans, medium risk. Observation. Of the total staff loans of 24 million, we noted that 5 million related to balances due from ex-staff of the company. From our test samples of total ex-staff loans, we noted that a total of 3.8 million has not been serviced for at least 4 years, and we could not obtain any evidence of efforts being made by the company to recover these loans. Details of the exceptions are highlighted below.
We can ignore the details. Go ahead with the implications.
Implication: the poor performance of ex-staff loans will lead to financial loss to the company, especially if there are no procedures to recover outstanding loan balances before staff leaves and staff leave the services of NAWEC. The lack of adequate effort to recover the overdue loans encourages staff who intend to leave the service of the company to borrow substantial amount and leave without settling. Recommendation: management should take steps in line with the approved staff loan policy to follow up on unpaid ex-staff balances and recover. It is also important to review the current loan application and disbursement process surrounding staff loans to ensure adequate collateral security is obtained with values that fully cover the amount borrowed to the staff, so that these could be sold to recover monies owed if need be.
Management.
This has been a concern for management, and efforts have been made to recover some of the loans taken by staff who left the service. However, some of them are paying, and those who have not been paying are within our jurisdiction have been written to through the legal unit. A good number of them have signed a repayment agreement.
We go to the second part of the report, which is on risk management. The finance department, high risk. Observation: we noted significant errors and omissions, requiring a lot of corrections that could not be addressed on time due to inadequate capacity within the finance department. Errors were found in prepared bank reconciliations, trade receivables, and trade payables, etc., and other misposting, which results in significant adjustment to the original trial balance provided to us at the beginning of the audit. We noted significant backlog in posting accounting transactions as well. Implication: although a lot of corrections were made, the financial statements still have a lot of limitations due to significant errors, omissions, and lack of supporting documents, which have not been resolved, resulting in qualification of the financial statements. Recommendation: management should conduct a thorough review and reorganization of the finance department to address the issues of concern raised. Attention should be paid to defining the daily tasks and reporting requirements of personnel within the department. An assessment of the staffing and skill required should be done to ensure that staff with relevant qualifications and experience are obtained or trained with assigned relevant tasks and responsibilities. Appropriate review and monitoring process should be put in place in order to minimize the amounts of errors and omissions and ensure efficiencies within the department.
Management.
Yes, a lot of errors were discovered and corrected. However, at the time of the preparation of the bank reconciliation, we had limited staff to do the reviews as a result of embargo on staff numbers, and this affected finance department. Furthermore, the company has expanded its networks, and thus volume of transactions also increased during the period. Nonetheless, efforts are being done and proper reviews are carried out henceforth.
Investments, medium risk. Observation: during our audit test on investment, we noted that 2 million was recognized as investment in Aqua Gambia Limited. Upon further review and inquiry, we were informed by management that the company received a directive from the Office of the President for the payment of 5.8 million to Aqua Gambia Limited on behalf of the Gambia government for first quarterly payment of its share capital towards the public-private partnership. Information available was insufficient to determine whether NAWEC had the obligation to invest in Aqua Gambia Limited, or the investment was made on behalf of the Gambia government and should be refunded to NAWEC. Furthermore, there is no share certificate or certificate of investment confirming NAWEC's investment in Aqua, and financial due diligence was not done prior to the investment. Implication: in the absence of adequate evidence and proof of investment, it will be difficult to ascertain the existence and the rights and obligations towards the investment made by the company. Without proper due diligence, the company may be making bad investment decisions which might not yield any returns and could result in financial losses. Recommendation: management should invest and regularize the cash flow made to Aqua Gambia Limited so that it is properly defined and classified in the books of NAWEC. In future, financial due diligence should be carried out before making such investments.
Management.
This was an executive directive, and we are yet to receive any sales certificate nor an investment certificate from AGWA. However, AGWA has been paying NAWEC 10% of revenue received from septic tanker trucks as agreed.
Ownership of Global Electric Group GEG plant. Observation: we understand that NAWEC took over the assets and operations of GEG power plant at Birkama from Global Electric Group Limited, an affiliate of Euro Africa Group Limited, in 2013. From our review of the transfer of ownership agreement, we noted that the power plant, including all assets of GEG, was mortgaged to Standard Chartered Bank Limited. According to the agreement, transfer of ownership of the plant and the assets was subject to NAWEC taking over and settling Standard Chartered Bank $8 million, which is $340 million. Up to the time of reporting, the $8 million was not fully settled to enable NAWEC to take over legal ownership of the plant. We were not provided with evidence confirming that NAWEC obtained right from Standard Chartered Bank to operate and manage the plant. Furthermore, the assets were not valued at the time of transfer of ownership, even though NAWEC committed to take over liabilities of Eagle with total international and local commercial banks. Implications: NAWEC is managing and operating a plant that it has no legal ownership rights. Considering that the company has not been capable of meeting its financial obligations to Standard Chartered Bank, there is risk of SCB taking legal actions and possibly sell the plant to recover the balances due. Without proper valuation of the plant and its assets, it is difficult to ascertain whether the liabilities taken over by NAWEC were consistent with the value of the plant. Financial due diligence was not done before the takeover, resulting in huge financial losses to the company, as noted in various financial commitments and obligations, including the acceptance of liabilities of the transferor with local commercial banks. Recommendation: management should endeavor to meet the financial obligation with Standard Chartered Bank to avoid losing possible rights of ownership. If it is confirmed that NAWEC has legal rights to the assets of GEG, all assets taken over should be revalued and recorded in the books of the company to ensure completeness and valuation of fixed assets of on the financial statement.
Management.
The former GEG plan was handed over to NAWEC in 2013, pending the full payment of the NAWEC indebtedness to GEG. We were later informed that GEG owed Standard Chartered Bank $8 million, which was included in the NAWEC bond, guaranteed by central government in November 2015.
We'll now be going through the accounting issues. Cash and bank, high risk. Observation: differences noted in the reconciled cash book and general ledger cash book balance. We noted significant reconciling differences between the adjusted cash book balance and the general ledger balance for the following bank accounts maintained with AGIP. It is a concern to note that even After all adjustments were made to reconcile the bank balances with AGIP, the adjusted cash balance still did not agree with the balance in the general ledger. The accounts affected are AGIP electricity. The adjusted cash balance is 103 million, and the GL balance had a negative $566,000, resulting in a difference of 103 million. The other account is AGIP Water. The adjusted cash balance is $70 million, and the GL balance is $601,000, resulting in a difference of unreconciled difference of $69 million. Bank accounts omitted in the books of the company. We also noted some bank accounts being confirmed by Central Bank of the Gambia and GT Bank as accounts maintained by NAWEC, but were not recorded in the general ledger as listed in the table below. The accounts affected are CBG NAWEC Birkama Power Station, and the amount is $653,000. CBG NAWEC Mini Grid Project, the amount is $19,000. GTB current account, $14 million. Implication: the significant unexplained differences and unreconciled transactions cast doubt on the accuracy and occurrence of the transactions. Omission of bank accounts in the accounting records renders the cash and bank balances in the financial statements incomplete. Recommendation: the significant differences noted in the bank reconciliations should be investigated and reconciled as soon as possible. Management should liaise with CBG and GT Bank on the confirmed bank balances and update accounting records if necessary to reflect omitted bank accounts.
Managers.
The difference noted in the reconciled cash book and general ledger cash book. The reconciliation difference between the adjusted cash book and the general ledger is normally listed as reconciling issues and not necessarily posted to the ledger to be the same. This bulk of the difference was as a result of the partnership account between NAWEC and AGIP, in which AGIP will buy and sell cash power meters on behalf of NAWEC and share the profit on 55% to 45% respectively. We decided to post the profit sharing only to the Access accounting system and not to post the other transactions to avoid overstating the revenue. Thus, every payment was captured on Excel for reference purposes. However, we have decided to post all transactions in subsequent periods. The bank accounts omitted in the books of the company. The CBG NAWEC Birkama Power Station account was opened by Accountant General account, according to the response we got from CBG. Similarly, GTB current account was opened by GTB as a control account maintained by GTB to monitor payments made by CBG for the NAWEC bond. However, the CBG NAWEC Mini Grid project was opened by NAWEC at CBG, but was later closed. This account was opened for a wind turbine project and was not implemented due to land issues. The donors requested for the refund of the funds, and the funds were refunded and the account subsequently closed.
Provision for bad and doubtful debts, high risk. The company's policy on bad and doubtful provision is as follows. For debts aged 7 years and above, write-off. 5 to 7 years, provide 20%. 1 to 4 years, provide 10%. Central and local government, they are exempted. Observation. A flat provision of 15% on total outstanding receivables amounting to $155 million was charged on the financial statements, which is inconsistent with the current policy on provision for bad and doubtful debts. The basis of provision was just a roundup computation charged on the carrying value of trade debtors, which is inappropriate and not supported. The company could not determine or identify the list of bad and doubtful debts. The current billing system does not generate a debtor's aging analysis, and receivables are not categorized to facilitate implementation of the current provision policy. Implications. The provision of $155 million charged and the valuation of receivables in the financial statements could be misstated. Due to the inappropriateness and limitation on the provisions made, the audit opinion is impacted. Recommendation. Management should identify and determine an accurate list of outstanding trade debtors, recompute and apply the appropriate provision in order to reflect accurate receivable balance in the financial statements. Additionally, age analysis of receivables should be generated from the billing system on a regular basis and provisions applied accordingly.
Management.
The new billing system in bracket Galaxy installed in 2011 could not provide an age analysis report as stated in our policy. Therefore, for the purpose of consistency, a flat provision of 15% used in previous financial statements was applied.
Property, plant and equipment, high risk. Observation. Difference between the schedule and listing. During our test on property, plant and equipment, PPE, we noted an unexplained difference of $540,000 between the fixed assets addition listing and the amount recorded in the general ledger. Understatement of depreciation charge. We noted a difference of $83 million between our recalculated depreciation charge and the amount recorded in the general ledger. This was not reconciled or explained by management. The difference is stated below. Our expectation, that is DTE's expectation, is $355 million, and what was recorded in the GL balance is $272 million. The difference is $83 million. Assets not capitalized. We also noted that works related to G6 overhaul at a total cost of $20.7 million has been completed since 2013, but this is still classified under work in progress instead of being capitalized and amortized. Implication. Understatement of depreciation charge results in misstatement of the net book value of the assets and profits in the financial statements. Due to the materiality of the difference, the audit opinion is impacted in respect of property, plant and equipment. Not reclassifying completed projects from work in progress to relevant asset categories results in understatement of depreciation charge and net book value of property, plant and equipment. Recommendation. The fixed asset register should be updated as when assets are purchased, and regular reconciliation should be done with the general ledger, and any discrepancies noted should be investigated and resolved. Depreciation calculated by the system should be reviewed regularly by senior personnel within the finance department. This will ensure completeness and accuracy of depreciation charge recorded in the income statement. All work in progress in the asset register should be reviewed regularly, and completed projects or asset enhancement should be reclassified to the respective class of assets and depreciated accordingly on time.
Management.
Difference between the schedule and listing. The difference between the listing and the schedule was 0.0523 million in bracket $52,300 instead of 0.54 in bracket 540,000 as indicated by the audit report. The payment was posted in the access, but the supporting document could not be found by the management accountant to be posted in the asset manager. Efforts are being made to trace the payment voucher, and we will correct it as soon as possible. Understatement of depreciation charge. Depreciation is calculated monthly by the asset manager system, and the parameters has not been changed. However, efforts will be done to work with the IT department and the service provider for review of the parameters. Assets not capitalized. This was an ongoing project, and the completion report was not available at the time. Nonetheless, it has been provided and posted in 2016. A regular review of all ongoing projects will be done, and completion reports to be provided by project managers so as to capitalize or reclassify the assets accordingly.
Long-term loans, high risk. Observation. During our audit of long-term loans, we noted total outstanding balance of $8.7 billion. As part of our audit procedures, we requested for a sample of loan agreements between the company and the financials, but these were not made available to us for our review. We also noted that there were no loan schedules detailing amounts disbursed to NAWEC, repayments made to date, interest accrued, balance outstanding, exchange rates, revaluation recognized, etc. We also sent external confirmation to the creditor, but significant differences were noted between the amounts confirmed and the amounts recorded in NAWEC's books. The exceptions noted were confirmed by Social Security, EcoBank, and from Bandes Bank in Venezuela, as detailed in the table below. Confirmations were not received for the rest of the creditors listed. Should I go through the table? Okay, for the Social Security loan, the amount recorded in the general ledger is $581 million, and the amount as per the confirmation is $583 million, resulting in a difference of $1.6 million. EcoBank loan of $30 million. The amount recorded in the GL is $7.5 million, and what is responded by EcoBank is $17 million, resulting in a difference of $9.6 million. Rest of the loans, that is Gambia government, ITFC, NAWEC bond account, EBIT, Badia, ING bank loan, Offit Energy, Offit Kotu Power Station, IDB loan Birkama Power Supply, IDB loan Birkama Power Kotu Ring, GNPC, ITFC, they are all pending. We are yet to receive the confirmation at the time of reporting. For the Venezuela loan, the amount recorded in the books is $894 million, equivalent of $22 million. What has been confirmed is $20 million. And the difference is $2.1 million. For the Ajib vehicle loan and the Ajib lubricant loan, the confirmations were not received. Implications. Without formal agreements on long-term loans, it is difficult to confirm the legal obligation of the loan and relevant terms and conditions of the contract that need to be honored. In the absence of loan schedules, the financial statements could be misstated if significant elements concerning the valuation of the loan, interest charges, and the annual repayments are not recognized. Financial loss, including legal and penalty charges, could be incurred in the event that the company could not meet its legal obligations. Differences noted between the general ledger and the confirmed balances are an indication that the loan balances recorded in the financial statement could be incomplete or misstated.
Excuse me, here. Where he mentioned this the loans, like can you just go back and read those ones? Like let's say Gambia government loans, amounts and pending all stuff there.
Well, you know what she's saying is that those ones are pending.
Yeah, we want her to read them out.
Well,
No, they want to read the amounts. I didn't.
okay. Now, what she has been doing is comparing what is recorded and what should be, and then see the inaccuracies.
Yeah,
but with the ones that are pending, it seems that cannot be done because she has not got the information. Could you guide us? Why did you just go ahead and say it's pending? It's because
we sent external confirmation to all these, to the issuers of the loan, so that we can see whether what they're confirming that they gave them as loan, that is what NAWEC recorded in their general ledger, because that's the only evidence we could have had to ensure the completeness of these balances in the financial statements. However, we've only got 3 responses, and those responses had differences. So the rest are pending. And it also led to a qualification in the audit opinion because we couldn't rely on any other evidence.
Yeah, so the objective is to look at the differences and at least register misstatements or inaccuracies, then sum up to give us the recommendation. So that's why she quoted just the 3. Yeah, go ahead.
Recommendation. Terms and conditions of borrowing and other contracts should be formalized and documented. Loan schedules should be prepared for all existing loans to provide guidance to management on the overall obligations and commitments of the company and how repayments are planned and monitored. The differences noted between the amounts confirmed and the amounts recorded in the general ledger should be investigated and reconciled with the relevant creditors.
The bulk of the $8.7 billion loan balance was as a result of project loans, the NAWEC bond and the central government loan. The agreements for the NAWEC bond and project loan agreements were provided. However, we agreed that there are no on-lending agreements between NAWEC and the Ministry of Finance and Economic Affairs regarding the project loans. Notwithstanding, we will engage the Ministry of Finance to provide NAWEC with formal on-lending agreements since they sign all externally funded project loans on behalf of the government of the Gambia. The difference indicated from Social Security and Venezuela loan was as a result of bank charges and exchange differences, respectively. As of EcoBank loan, we disagreed with the difference, and this may have been the addition of the overdraft facility with the bank.
Page 29 is missing that book, please. 29.
Trade payables.
So you now have 29.
Yeah, nice.
Yeah, okay, then go ahead. Yeah.
Trade payables, high risk. Observations. Differences between the general ledger balance and the trade payable listing. During our audit test of the trade payables account balance, we noted a difference of $13.2 million between the listing and the amount recorded in the general ledger. Details of the exceptions are highlighted below. The listing provided to us had a balance of $623 million, and the general ledger had $636 million, resulting in a difference of $13 million. We also noted some creditors' accounts with debit balances amounting to $26.1 million in the creditors' listing. Inadequate supporting evidence on supplier balances. We were not provided with detailed statements of the suppliers listed in the table below to enable us to carry out audit tests on the transactions. We also sent third-party confirmations to the listed suppliers but did not receive replies from most of them. For the few replies received, we noted differences between the amounts confirmed and the amounts recorded in the general ledger. Details of the exceptions are highlighted below. QSAL. The amount recorded in the general ledger is $5.2 million. The confirmed balance by QSAL is $4.5 million, resulting in a difference of $734,000. GACL GAMSAL. The balance recorded by NAWEC is $1.3 million, and the amount confirmed by GAMSAL is $3.1 million, resulting in a difference of $1.7 million. GNPC, the amount recorded by NAWEC is $466 million. The reply wasn't received. Global Electric Group, GEG, the amount recorded in the books is $55 million. We, at the time of reporting, we've not received a reply.
Could you just deal with the ones where you had the reply, I think?
Okay.
That's consistent with our original method.
Okay. Global Power System, the amount recorded by NAWEC is $32 million, and the amount responded by Global Power System is $62 million, resulting in a difference of $30 million. Takaful Insurance, the amount recorded by NAWEC is $12 million, and the balance confirmed by Takaful is $8.8 million, resulting to a difference of $3.6 million. For the rest, they are all outstanding. Implication. The errors noted above are an indication that creditors' records were not properly maintained or appropriately recorded. The creditor balances reported may not be complete or accurate. Debit balances in supplier accounts could arise from invoices being settled but were omitted or not recognized in the accounting records on time. There is also risk of suppliers invoicing and getting paid for goods not supplied. Without the statements detailing transactions and confirmation replies from suppliers, we could not ascertain the completeness and existence of the creditor balance in the financial statement. Recommendation. The difference noted between the listing and the general ledger should be investigated and reconciled with suppliers. Invoices received should be verified and posted on time, and this process must be strictly monitored by senior personnel within the finance department. Only approved invoices for goods or services delivered should be settled. All accounts with debit balances should be investigated and adjusted accordingly. The discrepancies noted above should be investigated and reconciled.
Management.
Trade payables. The difference was as a result of opening balance, and some of the postings were done through the nominal ledger instead of the purchase ledger, therefore not reflecting in the listing. The debit balances for some of the creditors were from previous years, during which we paid in advance and posted the invoice later when the goods are delivered. Inadequate supporting evidence on supplier balance. We agreed to maintain an Excel account for the big suppliers so as to reconcile them periodically to avoid such discrepancies.
Interest payable, high risk. Observations. Unsupported interest expense charge. Out of the total $74 million charged to the income statement as interest expense, we were informed by management that $66 million is related to interest accrued on some existing loans. However, we were not provided with the loan listing related to the accrued interest charged. Loan agreements and schedules relating to the above-mentioned loans were also not made available for our review. Other expense payable. From our audit of other expense payable balance of $56 million, we were informed by management that the account was purposely maintained for one of suppliers that do not have accounts with NAWEC. From our test on the transactions in this account, we observed that most of the invoices charged to the account during the year were subsequently settled. However, we noted that the opening balance of $56 million was still recurring and was not settled, as the closing balance remained at $56 million and could not be traced to any unpaid invoices. We found this very unusual for the nature of the transactions posted in this account, as we expect the balance to be low or identifiable to unpaid invoices. VAT payable. We developed an expectation of VAT payable at the year end and noted a difference of $73 million. DTA expectation was $105 million and the general ledger balance was $178 million. We were not satisfied with the explanation that it was a system error, as this was not substantiated. Implication. Interest payable in the financial statements could not be verified and may be incomplete and misstated. Other interest payable could not be verified as it is not substantiated, and limitation on the balance of $56 million has an impact on the audit opinion. VAT payable balance may not be accurate. Recommendation. A schedule of interest and other payables should be maintained and supporting documents relating to the liability being accrued and filed for review. The account balances noted above are material, therefore we strongly recommend management to review and tidy the accounts.
Management.
Unsupported interest expense charge. This is on interest payable over the years as a result of government loans to NAWEC. However, the 8.4 was in relation to Standard Chartered Bank interest payable on the NAWEC bond for November and December 2015. We will engage Minister of Finance on this to get a loan agreement. Other expense payable. This is as a result of opening balance dating back since 2009 when NAWEC acquired Access Accounting System. We will investigate and do the necessary corrections. VAT payable. We will investigate and do the necessary corrections.
Other income, other marginal activities, high risk. Observation. During our audit test on other income, we noted significant income of $273 million recognized in the other marginal activities account. Upon further review, we observed that significant inconsistent transactions were classified within the account, but did not match the description of the account. We understand from management that the account was created as a clearing account for cash received by cashiers from NAWEC staff relating mainly to retirement of interest. Summary of the transactions posted in the account are highlighted below. Cash collection and profit sharing amounted to $25 million. Settlement of Eagle debt, $250 million. Retirement of interest, $2 million. Settlement of invoices, $1.5 million. The most significant transaction posted in the account related to $250 million is recognized as discount received on the balance due from Eagle. We understand that the government of the Gambia negotiated with Total International and settled a debt due from Eagle to Total at a discount equivalent to $250 million on behalf of NAWEC. However, there is no evidence confirming that NAWEC was entitled to a discount for the difference, or Eagle has discharged NAWEC's obligation to settle the full amount due. The discount recognized was assumed by NAWEC but not formalized with Eagle. Implication. The nature of the different transactions posted in the account poses the risk of using the account as a dumping account susceptible to manipulation. As a clearing account, the balance should be nil at the year end, and it was wrongly classified as an income account as the retirement was not income to NAWEC. NAWEC may not be entitled to the discount of $250 million and may be required to settle Eagle as it was not previously formalized. Income could be significantly overstated and misleading. Recommendation. All the items within this account should be reviewed and appropriately accounted for. As a clearing account for Impress Retired, it should be classified as an asset account, and transactions posted in this account should be limited to that purpose. The account should be closely monitored by finance and cleared as when deposits are made into the bank. Profit sharing with AGIP is a key financing arrangement that should be accounted for separately and strictly monitored and reconciled with AGIP monthly. Management should reverse the discount recognized and seek formal clarification on the applicability of the discount.
Management.
This account is maintained for other income or other marginal activities like sale of bulk water, etc. We also use it to monitor retirement of Impress. We agreed to separate the two and have a different account to monitor Impress retirement. The profit sharing with AGIP will be treated separately from now on. The most significant amount posted to this account was a discount given by Total International to the Gambia. The Minister of Finance wrote to NAWEC to offset Eagle's exposure to Total International, which was $24 million, against what NAWEC owed Eagle, and was silent on the discount. Therefore, NAWEC used the discount since it was the purchase of fuel. Nonetheless, we will formally write to Minister of Finance to clarify.
Cost of sales, medium risk. Observations. During our review of cost of sales expenses, we were not provided with supporting documents for the transactions noted below. Date 20th April 2015, details timber and furniture, amount is $129,000. Implication, lack of adequate supporting documents makes it difficult to ascertain the occurrence of the transaction and whether the right treatment was applied in processing such transaction. Recommendation, all transactions should be accompanied by adequate third-party supporting documentation, and all documents should be properly kept and readily available for review.
Management.
We will investigate and do the necessary actions.
Interest expense. Observation. Interest expense on loans incurred during the year was not supported, and we could not trace the payments to the bank statements. Unsupported transactions are listed as follows. 28 February 2015, correct posting, the details is correct posting of loan, the amount is $416,000. 31st December 2015, adjustment of difference, $747,000. Implication, lack of supporting documents and inability to trace interest expense to bank statements makes it difficult to confirm the accuracy and occurrence of the transactions. Recommendation, all interest expense recorded in the general ledger should be supported and reflected in the bank statement as evidence that it occurred.
Management.
This relates to a NAWEC bond, and the repayment schedule was provided. However, the interest amounts could not be traced to the bank statements because the bulk amount were always posted by the bank. The difference highlighted were as a result of reconciliation of the account.
Revenue, high risk. Observation. In addition to significant errors noted and brought to management for corrections on differences noted between the revenue records in the accounting system and Suprema, that's the cash power system, we also noted that daily sales obtained from Suprema were not posted into the accounting system. Exceptions from our sample are detailed in the table below. Date 23rd September 2015, the sales recorded by Suprema is 442,000, and the sales and the amount posted into the Access accounting system, nothing was posted, resulting to a difference of 442,000. 1st August 2015, the amount recorded by Suprema, that is the cash flow system, is 140,000, and nothing was posted into the Access accounting system, resulting in a difference of 140,000. Implication: the omission of daily sales generated from the Suprema system could affect the completeness of the revenue recorded. The errors and omissions noted above imply that postings are not appropriately reviewed and that reconciliations between the finance and billing departments are not effectively carried out. Recommendation: management should ensure that timely reconciliations between the Suprema and accounting systems are performed on a regular basis. This will facilitate timely detection and response to errors. All postings into the accounting system should be properly reviewed by a supervisor before being released live in order to avoid posting errors.
Management.
This was actually detected by our staff during reconciliation and was later corrected. We will endeavor to have timely reconciliation. However, the challenge here is when certain staff go on confinement leave, the replacement is always a problem due to lack of enough staff, as indicated in note 3.1.
Revenue, high risk. Observation. Our audit test on revenue revealed that a customer was overcharged by $35 million for electricity consumption at Gam Petroleum facility in Mandinal. The error was detected by the billing department and the reversal was effected in 2016 instead of the period under review, that is 2015. We could not determine the appropriateness of the transaction as we have limited information as to how the error was detected, procedures taken to identify and report the error, the relevant authority that approved correction of the error, etc. Implication: if the adjustment of the error is found to be appropriate, omitting the correction in 2015 contradicts the margin concept and revenue could be overstated by $35 million. Recommendation: management should review and confirm the validity of the error and relevant approval obtained to correct the error in the year under review.
Management.
The $35.1 million, it was a direct sales adjustment made while the customer account was created in the billing system in September 2015. This was not part of the September 2015 sales because it was done outside the normal billing time. That is why it was posted separately as an audit adjustment. The $35.1 million was part of errors detected and adjusted for on 23rd March 2016.
Grant agreement, low risk. Observation: we were not provided with the grant agreements for the Danish and Dutch grants for our review. Management could not explain the basis and computations relating to annual grant amortized into the income statement. Details are highlighted below. The carrying value for the Dutch grant is 563,000. Danish grant is 32,000. Total amount is 596,000 million. Amounts released to the income statement for the Dutch grant is $16 million and Danish grant is $5 million. Implication: failure to provide the grant agreement makes it difficult to ascertain the accuracy and valuation of the carrying value of these grants. Recommendation: all grant agreements should be properly kept and filed for future reference. Management should ensure that there is a basis on amortizing the grants and a schedule should be maintained and filed.
Management.
The computations of the carrying value and the amounts released to income statement of the Dennis and Dodge grants were inherited in the financial statements, and the values are recorded according to the previous explanations. These grants date back to the late 80s during the First Republic, and we could not find the agreements. However, we'll endeavor to cite for them.
Inventory, high risk. Observation. During our review of the inventory balance, we noted a difference of $10 million between the listing, that is $321 million, and the general ledger, $311 million. This was not reconciled or satisfactorily explained. From the sample of stock items selected and tested for valuation, we noted a potential overstatement of $15 million due to wrong prices used in the valuation of the stock items. We also noted that some stock items included in the valuation report were not priced, thereby understating the stock balance in the financial statement. From our review of corrections made to stock records, we noted a list of good received notes totaling $18.5 million identified as unposted good received notes from Kotu Power Station by the stores department. We tested a sample of the GRNs and noted a potential overstatement of $4 million resulting from wrong invoice amounts recorded. Implication. The discrepancies and errors noted above is an indication that the inventory amount recorded in the financial statement could be misstated. The risk of pilferage is very high where the stock management controls are weak and not effectively monitored. Recommendation. Management should consider carrying out an independent inventory count and revaluation of all stock items in order to ensure correct stock values are maintained in the records. The inventory management controls system should be reviewed, strengthened, implemented, and monitored. An independent person should regularly review the postings made by the stores department. Errors or omissions noted should be investigated and corrected immediately.
Management.
The difference of $10 million mentioned is due to the fact that the closing stock for Birkama 1, formerly known as Birkama GEG, was not posted into the general ledger at the time of the audit exercise. The wrong prices mentioned were because the foreign currencies were converted into dollars using wrong rates, but we have corrected most of them. As of the $4 million, the invoice value was mistakenly recorded by the storekeeper in foreign currency when it was supposed to be in dollars, and that price was further converted to dollars and corrected.
Exchange loss, high risk. Observation. We noted that an amount of $185 million is recorded as exchange loss. Upon further review and inquiry, we were informed by management that the exchange loss was recognized on stock. Apparently, the closing stock balance in the general ledger was compared to the physical stock value, and the difference of $185 million is noted, recognized as exchange loss in the income statement. This is not in line with proper accounting, as the difference could be stock movement, fraud, errors, etc. Additional exchange gain of $8 million was recognized in the income statement. This was derived by comparing ING euro loan recorded in the general ledger equivalent to $8 million with the euro closing balance in the bank statement equivalent to $5,000, and the difference was recognized as exchange gain. Again, this recognition is inappropriate as there is no evidence confirming that the difference represented an exchange loss or gain. This difference could have been a settlement debited by the bank and not reflected in NAWEC's cash book, or an error, etc. Implication: the income statement may be misstated due to wrong exchange losses and gains recognized without proper justification. Recommendation: the adjustments raised should be reversed, investigated, and corrected.
Management.
The exchange loss of $185 million is an accumulation of 3 accounting years starting from 2013, when GEG plant was handed over to NAWEC and spare parts purchased for the power station were not posted into the general ledger at the time, even though the stock was recognized at the year end. The exchange gain of $8 million was as a result of euro loan obtained from BISIC and paid to ING Bank of Netherlands for the Brikama water treatment plant. The difference was the rate used at the time the loan was taken and the ruling rate at the year end, which was far less than the rate used earlier. Therefore, exchange gain was recognized for the difference.
The next section is on status of prior year management letter. Following the prior year audit of the company by the previous auditors, key recommendations for improvement were made. We carried out a review of those recommendations to determine the extent to which some or all of those recommendations were implemented and noted the following. The first observation was fuel management. The observation by the previous auditors were during our review on the fuel used for the company vehicles, we noted that there is a fuel voucher which states the department date and vehicle number and quantity supplied. However, we also noted that there were instances in which the same person that authorized the supply received the fuel with the same signature. The recommendations by the previous auditors were, we recommended that there should be adequate segregation of duty in place between the personnel approving and the one receiving the fuel. Status of implementation, it is currently implemented. Cash power sales agent. The previous auditors noted that NAWEC and Eltin Gambia Limited had signed a sales contract for which Eltin is a non-exclusive sales agent of NAWEC for the sale of prepayment electricity unit tokens in the Gambia. Section 18, reconciliations of the contract states that both parties should identify designated staff to reconcile on a weekly basis all the transactions carried out by the Eltin personnel. We noted that the internal audit unit is not involved in the reconciliation process. We also noted that daily cash power sales proceeds, which should have been paid into a NAWEC designated bank account, were sometimes paid into an Eltin bank account, which is not in compliance with the sales contract. The recommendation by the previous auditors was we recommend that management should ensure that the internal audit unit of NAWEC is involved in the reconciliation process on the cash power sales by Eltin. We checked the status of implementation, but for that point it was not implemented. The next point, the recommendation by the previous auditors was NAWEC to ensure that the contract terms on the banking of cash power sales proceeds is being adhered to by Eltin, and that is implemented. The last point by the previous auditors was Revenue Protection Department. We requested for the logbook, which records customer complaints of leaking pipes, which will state the time it was reported, the location when it was sorted by the field officers, but it was not provided for review. We also requested for fault service reports with regard to electrical issues, which states the remarks from the technician and noted that there is no evidence of review after the technician has checked it, and it does not indicate the date, the time the fault was reported, and when it was resolved. Recommendation by the previous auditors was, we recommend that management should improve on the record system of the Revenue Protection Department, which will help in determining and rectifying the effectiveness of the unit. We checked the status of implementation, and that point was implemented. Thank you very much.
Thank you very much. Now we thank you for the detailed presentation, and the last report we are expecting is PPA compliance.
Thank you very much, Honorable Chair, honorable members of this very important gathering, Board of Directors, NAWEC, and Managing Director, and all other staff, and all other protocols duly present here. Now, if honorable members may observe, realized that GPPA compliance review is missing among those documents that are submitted by NAWEC. And the simple reason is to believe that NAWEC was not subjected or is not supposed to be reviewed by the authority during the period under review. Now, if I may cite the report by the managing director, now you will all agree that a lot of activities were conducted, and most of these obviously are procurement related. And of course, we'll all also agree that it is very important to have good procurement procedures and policies in place to ensure value for money in whatever activities are conducted. But regrettably, like I said earlier, we have not been reviewing NAWEC for those periods under review. And of course, for the subsequent years, it was not until when the new management took over that staff of NAWEC were engaged in a lot of discussions, and of course they agreed that they are obliged to comply with GPPA. And from there, they started taking actions because already they have set a contrast committee in place as provided for by the Act. And since late last year, we started training these members of the contracts committee. And as I speak now, GPPA training team is at NAWEC, training some of their key staff, meaning that they are very much aware of the importance of procurement, and they are willing to comply with the provisions of the Act, because the first thing is to ensure that they are aware of what is happening, and those involved in procurement are trained to acquire the right skills to ensure that processes and procedures are followed as provided for by the public procurement law. So in short, what I am saying is, like, for the year under review, NAWEC was not reviewed by GPPA, and hence we are not in a position to determine their compliance with the provisions of the Public Procurement Act. Thank you.
Well, members, we've been informed that there is effectively no report. So what is before us is clearly that we cannot deal with the issue of compliance. And the proposal is that these are issues that we will be looking into, and we may as well adjourn and then consult in terms of the date that we intend to engage in NAWEC for intensive review, and then prepare our report. So if we agree that there is no further issue to raise with them in terms of presentation, because the objective is simply presentation of their reports, then we may adjourn. Is there any technical issue that we wish to raise? Yes, Member for Basen.
Mr. Chair, thank you very much. We are going from the board, and again, if I refer the member, the officer from EPPA to their act, we got to know, even not here, even in writing, the reason why in the previous under review, NAWEC was not reviewed. We can provide reasons even in written, so that the committee will know something about it. These are my submissions.
Yeah, there is a proposal that you give us a written report of exactly what you've mentioned here, so that will be part of our documentation. Thank you. Well, you know, the issue is that they were presenting a report. The members are saying, board chair, that if you so desire, you may make a statement. What we have received is what we expected from you. Now, before closing, if you have any message to give, then you may do so.
Thank you very much, Honorable Chair. I need not remind this august body that we are new in the game. I think we came into operation some 6-7 months ago, and as you can see from the audit report that we have been put through, there are lots of issues that we have to deal with NAWEC. I mean, apart from the GPPA compliance that we have actually insisted on, there are a lot of irregularities which we are battling with to correct. As you heard, you know, NAWEC was operating some 39 accounts. I mean, it's not acceptable. And the fact that reconciliations were not made regularly, I mean, there's no doubt in anybody's mind that we could not, there's no proper accounts that could be kept. And there's a statement made by the auditors that NAWEC is not viable. And this is a real concern, because the challenge that we have as a new board is to see how we could change this around. And with this comes a lot of dedication on the side of the board members. And I must say that we are wrestling with the many problems that we have. And in as much as we cannot comment much on the accounts of 2015, I think we could safely say that in the coming years, we have a mandate of 2 years. In the coming years, we are sure, I'm confident that will certainly make a difference. It is very difficult for anybody to defend reports submitted of this nature, because there's nothing pleasant about it. But of course, we understand some of the circumstances, because, for example, I mean, the contamination and exploitation made by companies like Eurofinance, Africa, and Global Trading, these are unprecedented. Nobody can understand why such huge sums of money were actually extracted from NAWEC. NAWEC is indebted to the extent where it is frightening. But like I say, I mean, with the sound cooperation that I have from board members, and of course with management, especially the managing director, we hope that if we're here, the next year round is going to be a different story. And I think this is all I can say for now. And we have to eat, as it were, the humble pie, because the reports that we are hearing they're not pleasant, but we have to accept it all in good faith and hope that the next time round the reports that we present will be much better. Thank you very much.
Thank you very much, Honorable Chair. And clearly, and that was the wish of the members. Left to me alone, we would not have put that burden on you to appear as if you are actually apologizing for the mistakes of the past. But what we are here for is to get a fair reflection of the state of affairs of the institution. And once we know that, then we know what needs to be done, what the challenges are to make the institution viable. And that's why this exercise is really not an indictment. It is simply to know exactly what is happening and to know what should happen. And from the recommendation, we assess whether they are being implemented and we move on. We will be coming to 2016, we will see whether any changes have occurred, and then to 2017, hopefully your era may give us other reflections. So essentially we have started the process, and that is why we indicated that the backlog should come to an end. Just imagine this was there all the time. So once we finish with the backlog, it means that we'll be able to make fair assessment of what is happening. We'll see the mistakes on time, we'll be able to address them on time, and then make those institutions to become viable. So we'll accompany you in the process and see us as partners. We will eventually review all this and take on board the recommendations that are made if we deem them to be viable, and utilize them as the basis for institutional reforms. So we thank all of you. We'll write back to you we'll check the dates. Our team will meet, check the date when we can sufficiently do our work of scrutiny, tease out all the issues that are mentioned, and then be able to come up with a report and recommendations that will impact on the development of the institution. Thank you very much for your cooperation, and we hope this cooperation will continue. We go back to our original, the way we started, to close that way, and that is people, meditation, their prayers, and then we move from there. Thank you very much. Members, I think we can adjourn. Yeah. Thank you very much. Auditor General, well, yes, we members and subject matter specialists and aides, please remain. So what are you doing? To serve them well. And the representative of the clerk is checking whether they have lunch that they can also serve you. So they will meet you outside.
Wala